Hi, folks. Dan Bird here for Technical Tuesday, August the 19th. I'm going to talk about standard deviation and different ways you can plot it, what it is, what it means, and how you can use it in charting and trading. So stay tuned for that. I am not a financial advisor, so this is for educational purposes only. By the way, this Saturday, I will be doing a Zoom call for subscribers, and this will go for as long as you want it to go. My wife is out of town, so I can stay on for 5 hours if you want. But I doubt we're going to go that long. But it's pretty much interactive. It's open to any questions, anything anybody wants to talk about. People can share their own experiences and own knowledge. So it's just basically a knowledge sharing session. So that will be this Saturday at 1 p.m. Eastern time. You can just click here and sign up for that. Log into the room on Saturday at 1 p.m. Hope to see you there. So let's take a look and see what the market did today. First, we'll go to the chart. We'll go to the 10-minute charts like we did earlier. I think that continued to sell off right till the very end. So yeah, so market kept selling off. So we looked at it right around here, right around 11:30. Continued to go down. Right at the end of the day, it came back. You can notice the volume at the end of the day. That is market makers rebalancing their books, which they do 10 minutes before the close. So that happens every day. See, volume does not necessarily mean anything for the following day. So we'll see. But with a sell-off like this, typically it will bounce some the next day. So money flow you see is still down, still negative up here. Technology continued to sell off. Financials went sideways, pretty much. Discretionary hung in there. Communications came back a little bit. Industrials came back down and pretty much flat for the afternoon. But the important thing is the defensive sectors. So healthcare continued to go up. Staples went up. Energy went up slightly. Utilities definitely going up. Materials going up. So that's the rotation. Rotation continued through the end of the day. Big sell-off in the afternoon. It's still not back to last Monday's open, though. So even with that sell-off, and the VIX ended at 1558 roughly, so still below 17. So this is not a panic sell-off by any means. Rotation, growth versus value. You can see there's the rotation. In fact, if money rotates from one area to the other, that's actually good. It'll keep the market up, even though it may pull back. The worst thing is when money goes out of all the sectors. It's not rotating. It just disappears from all the sectors. That's when the market will really start to crash. But that's not really what I'm saying. It's moving out of growth and into value, which is a defensive move. Discretionary versus staples a little bit. Technology, clearly, you can see that going down. Semiconductors going down, even heading even lower at the end of the day. And then internet also heading down. And if we look at the Russell 2000 mid and small caps, it sold off as well today. It's kind of a rounded bottom. So it's sort of leveled off right here at the end from 1 o'clock until the close. But again, you'll see growth versus value, large cap, mid cap, and small caps. All of these, money was rotating out of growth and into value. That's what it means when this is going down. And that has actually been happening since all the way back here last week. So even with this big uptrend right here that we had for 2 days last week, the money was rotating out of growth and into value. So that gives you a clue of what's happening underneath the covers and what traders on Wall Street, how they're positioning themselves. So even as it goes up, the rotation is out of growth. That typically means that we probably will see this continuing to head down. Now it's pretty much right on a important support area right here. You can see it's right on that support area where it hit twice last week. So tomorrow we'll see what happens. If it continues to go up or down. Friday is the Fed. Powell will be speaking. I think it's at 10 a.m. Friday morning. So traders might be positioning, trying to go to cash. And that may happen tomorrow and Thursday before that meeting. So we'll see. We'll see what happens. All right, let's go back here. And just out of curiosity, I'd like to look at the volatility chart again and see what that looks like at the end of the day today. See, the S&P is sitting right above the 21 EMA. This has not crossed over yet, but the momentum is starting to move lower. So we'll see what happens tomorrow. Tomorrow's going to be really important for this and a number of other areas. Let me show you. I talked about some of the large cap when I did the scan, but let me show you on the market bias page for subscribers. Notice right here that it's rolling over a little bit. Had a big downtrend, then it started to come back up. Short term started coming back up. Now both short and medium term are starting to roll over again. But check this out. I'm going to step through each of these real quick, and you'll get a sense for what this looks like. So we've broken this. Remember the up channel that I talked about before, that many times those break to the downside? It now has broken through the bottom of that channel. So again, tomorrow is going to be important to get the 21 right below it. But let's step through each of these. This is what I look at every night. There's the NASDAQ. There's the Dow, which actually was the best index, best looking one, and it ended with a shooting star candle. So that could be a reversal. There's the NASDAQ 100 sitting right on the 21. There's the S&P 100, mid caps, small caps, New York Stock Exchange. All three of those have shooting star candles. Here's the Russell 2000. There's the Russell Growth and Russell Value. You can see definitely growth looks worse than value, but value also has a shooting star. Transportation. Utilities is the one that held up the best. And then these are the sectors. So there's technology, there's communication, and there's discretionary. Those are the three aggressive sectors. Discretionary, which had been doing pretty well, but ended with a shooting star. That's maybe a reversal. We'll see tomorrow. Then the next three are the defensive areas. So here's staples, definitely higher, utilities, higher, and healthcare, higher. So the defensive ones look better. So that clearly shows you rotation into the defensive areas. So that's what they look like. And this gives me a sense every day of what the whole market looks like. There's semiconductors heading down. Here's software, definitely big red candle today in software. Here's clean energy. Here's artificial intelligence heading down. Here's robotics. Here's autonomous vehicles, cloud computing, cybersecurity, biotech. Notice all the big red candles. Home and construction, I mentioned this earlier. This is the one that actually did pretty well today. Home construction was the one area, and also transportation. Insurance did pretty well, heading up, and banks. This is the large banks that has a shooting star candle, and regional banks, the same thing. So we'll see how this turns out tomorrow. It'll be interesting to see what happens. All right, let's go talk about today's Technical Tuesday standard deviation. So what is standard deviation? First, let's get a definition as it relates to stock trading. Standard deviation is statistical measurement, shows how much a stock's returns vary from its mean. So it shows volatility. High deviation means high volatility. Shows risk. So more volatility means greater risk. This gives you an example right here, but standard deviation of 2%. If the average return is 8% and the standard deviation is different, one is stable with low risk and high standard deviation is high risk. And what indicators use this? Bollinger Bands is the key one. That's the number one indicator that uses standard deviation in particular. So it does the upper and lower bands, and I'll show you what these look like in a second. So upper band potentially overbought, lower bands potentially oversold. So standard deviation, positive or negative. There is a standard deviation indicator. I don't really use that too much. Donchian channels, which you can plot in stock charts. They're just called price channels, but they are actually these Donchian channels. And then ATR, which I talk about a lot, average true range, is not actually standard deviation that it uses, but it does measure the range between high and low prices over a period, like 1 day, 2 day, average true range, etc. So I use all of those. So let's go take a look now at I'm going to use IBM as the example. So let's look at the chart for IBM. And the reason I'm doing that is because it has a pretty wide range, up moves and down moves. So that'll give us a sense for what it looks like. Notice down here that all of the relative strength and money flow is pretty low. So money flow is flowing out of IBM. It's below all of its moving averages, including the 200. First, let me get rid of all of these. And then let's build back in the Bollinger Bands. So the default for Bollinger Bands is 20. It's a 20 period. I always like to use 21 just because it is a Fibonacci level. But you don't have to do that. You can stick with 20. 20 is the default. Makes it easy. Just stay with the default. And this here is 2 standard deviations. So that is the default for this. And you can see here 2 standard deviations when IBM hit it up here at the top and then hugged that line all the way up. That was a clear uptrend. And then it pulled back right to the mean. That is reversion to the mean. So right back to the center line. That's the 21 moving average. Then it went up and hit the 2 times standard deviation again and came right back to the center line, but went back down to the lower one. Now notice right in here how these Bollinger Bands are kind of squeezed together. That's how the squeeze is created. In this case, it's 2 standard deviations. Now, what if I wanted to show 3 standard deviations instead? So let's use Bollinger Bands. We'll make it 21 again. But in this case, we'll make it 3 standard deviations. And let's make it red so you can see the 2 of them. And make it a dashed line. All right, so now there's 3 standard deviations. So first thing to notice is it rarely gets all the way to 3. So if you're looking for a stock to make it to 3 standard deviations, you might be waiting a long time for that to happen. It made it here right here, but look at the run it had already gone through. Now, what you want to do is wait for it to get to 3 standard deviations to the downside, and that is potentially the reversal. So 3 standard deviations to the upside right here is potentially a reversal back to the downside. So remember that, keep that in mind. Also notice again back here where IBM just sort of went sideways for a while, and the Bollinger Bands or the standard deviation got squeezed together. So the standard deviation from the mean, in this case 21, the 21 moving average, it was not deviating very much. So it stayed right within that 2 standard deviation right there. And then when it starts to get volatile, either to the downside or the upside, and standard deviation and Bollinger Bands do not tell you which way it's going to go, but it will tell you when it's at an extreme. So if you want to look for an extreme, you could look for the 2 standard deviations and hopefully ride it up. That's what John Carter uses in his new momentum indicator. That's one of the components. He also uses volume, but one of the components is it riding up the Bollinger Band like that? And that would be a momentum, upside momentum. Same thing over here. It's riding the downside, riding the Bollinger Band to the downside. So this would have yellow arrows pointing down because it's riding the 2 standard deviations to the downside after hitting the upside, getting reverted to the mean, and then continue to go lower. So that's what the standard deviation, what the Bollinger Bands look like. Now, there's one other way you can do this, and that is rather than 21 EMA, so you can change the length as well. So now let's do Bollinger Bands. In this case, let's use 65. 65 typically is a 1-week Bollinger Band, and we'll use 2 standard deviations in this case. So now you can see that is the green lines over here. Let me reduce the opacity on these, and I'll make the green one stand out. So now you can see the weekly standard deviation is much wider. And I can do the same thing, make this 65 and three standard deviations. Then I'll make this one, that one's green. Let's make this one pink. So now you can see, once again, this is a weekly 65 period, 3 standard deviations. So now it's much further out. So sometimes I like to put these on. I like to look at that if it's riding the standard Bollinger Band up. This gives me a sense for where it might go to. So in this particular case, you take this one back off again. Usually when I change the time frame, I just use 1. So 65, 2. So think of that as a weekly. Notice how I hugged this this bluer Bollinger Band on the upside, and then the weekly, the 65, gives me a sense for where it could go to. So it started moving up. Let's see. No, I don't want the red. I want the blue. And let's make that a little darker. All right, so here's the 2 standard deviation, which is the default. Notice it went up and hit it. It did not get rejected and move down. It started moving right with it. So what I want to see is, how far do I think this might go? How far up will it go? And that's why I put the 65, a little bit longer time frame, put the 65 on there, and that gives me a sense for where that might go to. Now, and it did. It came back to the mean right there, and then it went back to the blue again, but the blue and the green now are right together. So it just followed both of those up and then finally broke down, came all the way back down, and you can see it came right down to the green, the 65 right here. So it's useful, it's helpful sometimes to look at both of those together. Now, how does John Carter use these? I've talked about this before. This is his squeeze right here. So in this case, it's using a combination of Bollinger Bands and average true range or Keltner channels. So this is the same chart using the average true range or the Keltner channel. So this green one is 1 average range up and down. The blue one is 2 times the average daily range up and down. And the red one is 3 times the average range. Notice over here, as it was riding that Bollinger Band up, it actually hit the 4, it got into the 4x. You can see it hit the 4x here and then reverted to the mean. Hit it again right here, reverted to the mean. So it came right back down to the 21. So that's a way you can use it as well. So what John Carter does is he puts them both together, and he says, if the Bollinger Band, in this case, the Bollinger Band is a 13, 2, so it's 2 standard deviations with a 13 period. I also have the 65, 2 in here as well, again, just to see where potentially it could go to. So the 65 is the gray area. So you can see right here, when it went down, that's right where it went to. So 65 over here, it went right up to the 65 right there, bounced off of it, and they both ran together. But what this does, when the Bollinger Bands squeeze together, because it's using standard deviation, so it will adjust for volatility. And that's what creates the squeeze, where it squeezes together between these blue areas. And then the green is actually the average true range or the Keltner channels. In this case, it's also a 13 period, but 1.5. So it's only a 1.5 width of what it typically trades in one day. So when you get these bright green areas here, that means the Bollinger Bands or the volatility or the standard deviation has squeezed inside of the average true range. And that's usually where you get a huge movement where it's kind of winding up like a spring. Doesn't tell you which direction, but in this case, it fired to the downside. In this case, it fired to the upside. So that's how you can use the 2 of those. Now, I want to show you one other thing that is pretty interesting. Now, keep in mind, this is what John Carter used. He used this for his squeeze indicator. So this is basically what it does, except what he did was he used multiple indicators like this and just converted it into a very simple dots down at the bottom to tell you whether or not it's in a squeeze, rather than looking at all of these colors and everything. He did the same thing with the Bollinger Bands by, like I showed you with IBM, by when it starts to hug the Bollinger Bands, that's a momentum, and he will give you arrows. But what he's done is he's just used all of these indicators, put them all together, and created one for himself. Now, there is an indicator on stock charts called the trend meter, which is a very interesting indicator. And I'm going to start using this in some areas, and I'll show you where in a second. So this is the Shande. This is the guy that created it. Just think of, what John Carter created with his squeeze. This guy, Shande, created one called the trend meter. So same idea, same concept. He took multiple different indicators, put them together, and created one indicator called the trend meter. So what is this made up of? Positions of the high, low, and close relative to the Bollinger Bands that we just talked about in 4 different time frames. 20-day, which I showed you, the 50-day, 75-day, I like to use the 65, and the 100-day. So that's one of the components of this trend meter. The next component is the price change relative to the standard deviation over the past 100 days. So how does the price change based on the standard deviation over 100 days? The next one is the regular RSI value, which I've covered here before. So relative strength shows you the relative strength based on the last 14 days. And then finally, the existence of any short-term 2-day price channel breakouts. So the price channel that I showed you before that just broke out to the downside on the S&P, in this case, it uses a 2-day price channel breakouts. And he puts all of this together to give you a sense for what the trend looks like. He puts it all on a resulting score converted to a 0 to 100 scale. So what does that then look like? So the scale, if it gets a score of 90 to 100, remember all of these different indicators. Score of 90 to 100, very strong uptrend. 80 to 90, strong uptrend. 60 to 80, weak uptrend. 20 to 60 is either flat or in a weak downtrend, and then below 20 is in a very strong downtrend. So interestingly, what he does with this indicator, basically using primary use of this because it's using Bollinger Bands, is the standard deviation. And by the way, I think you can get to this even if you're not a Stock Charts member. Just go there and type in CTM up here, and you can study this even more. So what it does is it actually shows you a color-coded image of the levels based on very strong, weak uptrend, weak downtrend, or a strong downtrend. And that's what it looks like. So that's kind of cool. So again, he's using standard deviations to do that. Now, what I did was I took that idea and I created a new favorites button down here, number 12. Number 12 used to be just a number of moving average lines, which is still in my list right here. I call it the moving average squeeze. So this is what it used to look like. It shows you all the moving averages together. But now what I've done is put the trend meter in here. So now on any particular stock, I can look at the trend meter. So this is the stock itself at the top. I have a 21-day moving average and a 50-day. So if the 21 is above the 50, then it's green. If the 21 is below the 50, then it's red. So that's a downtrend. And then I put a chandelier exit, which I covered in a previous Technical Tuesday, but it basically just uses math to help you identify where your stops should be. So if it goes below this exit line, then that's where you should be out. Now notice how it almost maps to the 21. So you can use the two together pretty nicely. And then right below that is the trend meter. So we can see over here when it dropped below the 21, especially when it dropped below the chandelier exit lines right here, we're down in a weak uptrend. This is a weak downtrend. This is a strong downtrend. The dark green is a strong uptrend. So by putting both of these together, it basically shows you what the strength of the trend looks like. And you can use these together, number one, for setting stops, but number two, for entering. So as you know, I like to enter when we get a green bar above the 21-day right there. And of course, these bars right here in and of themselves show you trend and momentum, just the bars by themselves. The green bar means both have upward trend and a momentum. A red bar means both have downward trend and momentum, and a blue bar means they're neutral. So let's take a look at when it went above the 21, which is right here. And you'll notice the trend down below was weak downtrend. So you might want to wait until it gets above the 50, or even when it gets into the uptrend area right there to enter. And then over here, when it closed below the 21 is when I like to exit, especially on a red bar. There's 3 red bars in a row right there. You'll see that the trend meter was all the way down at the bottom of the weak uptrend and heading lower. So the trend was already dissipating. So using both of these together gives you a really good idea of when you should be entering or exiting the trade. Now, for subscribers, on my website, on the chart list and scans page, I have all of my favorites buttons. I have not changed the moving average one yet, but I will do that tomorrow. I will change that to the trend meter. So if anybody that has stock charts wants to use that as one of their favorites, it's very easy to come in here and just click on that. I'm also using it on the home page, and at the top over here, at the top of the pinnacle, you'll see the red lights, red and green lights. Right now we have a green light still. And if I click on that, you'll see at the top, we have the bottom is the trend meter that I just talked about. The top is where I set my stop lights, the green, yellow, and red. So those are basically support and resistance areas that I have chosen. Anybody can change these. Trend meter down here is automatic. It automatically does these colors. So you can see that the trend now is in a reasonably strong uptrend, but it's moving into a weak uptrend pretty soon. But it's still above the 21, so it's still in the green up here. But that's a very easy way you can see what the status of the market is just by coming to the homepage. And anybody can do this. You don't need a subscription for this. Click on this little green light right there, and you'll get a sense for what those trends look like. So hopefully that helps explain the standard deviation. I know some people say, wait for 3 standard deviations. It's very rare to get 3. So you might be waiting for a long time. If you're waiting for 3, I think 2 standard deviations is certainly an extreme level, and usually you get a reversion to the mean when that happens. So I think that's what I would be looking for. All right, let me know if you have any questions, if this was useful, if you thought this was a good Technical Tuesday. Anything else that you would like for me to check out or talk about in a future one, I'd be happy to do that. But this now is one of my standard buttons, which I will be reviewing this now for other stocks and some of the ones we covered earlier today, some of the big ones that were heading down. So there's NVIDIA. It's got a red bar below the 21 right there. That is the exit. And it's just the trend meter has just moved into a weak uptrend. GEV, just step through some of these, has had a red bar for quite a while. It has now moved into a weak downtrend. So it's moved into the lower quadrant down here. So that could be just beginning. It's below the 21. So that could be just beginning. AMD, red bar, a weak uptrend. You can see the trend meter down below. By the way, it's sitting right on the chandelier exit, which is where you should set your stop. So if it drops below that, even though it's below the 21, it's not below the chandelier exit. So you can have 2 check boxes here for setting your stop or exiting this particular stock. Right now it's below the 21, but it's not below the exit, the chandelier exit. Let's go back and look at NVIDIA. Again, same thing. GEV, that's sitting right on. It's below the 21. It's sitting right on the exit. Palantir, that one big. That's below everything now. 2 red bars, and it is heading very rapidly down here to the downtrend area, the yellow area. So this is a really good way you can use this. Very simple to see what the status of any stocks that you're looking at. There's Eli Lilly. It's moving from a strong downtrend to a weak downtrend. Still a downtrend, really needs to get above this 50 area to start into an uptrend. But anyway, that's one way to use standard deviation. And one of the indicators that are standard in stock charts, if you are a member of stock charts, is this Shanday. It's called a Shanday trend meter. And you can get to it down here in the indicators bar. So any stock that you put in up here, come down here to the indicator Shanday trend meter. It's right there. Just choose that. You can put it below or above, and it will automatically, I put a horizontal line. I put that 50 area in just to give me a sense for where the midpoint is. But when you use it down here, it automatically colors it for you. So you don't have to do anything else. It will do that automatically. All right, thanks for watching. Hope this was useful, and we'll see what happens tomorrow. It's going to be really important the next 2 days to see what the market does heading into Powell's speech. Powell's speech has the potential to move the market. I think everyone's expecting to hear something dovish, but if he either talks more hawkish or does not say anything dovish, then that could send the market even lower. So we'll see. We'll talk about this again tomorrow. By the way, tomorrow's session, I won't be able to do one midday, so I'm going to do an after the market session tomorrow. So watch for that. If you don't see something at midday, I've got a bunch of appointments tomorrow that I have to get to, so I'll do one after the close tomorrow. All right, thanks for watching, and we'll see what happens. Take care.